How's it going, everyone? Just want to touch base. We've got another Fed rate hike coming next week, and just want to explain to everybody what is the Federal Reserve Bank, what are they currently doing, and what is that going to do for the markets in 2023 on today's Market Movers. So what is the Federal Reserve Bank? The Federal Reserve is made up of 12 regional banks, 24 branches, and what are called 7 governors. These are voting members on the Fed. And the job of the Fed is a dual mandate that Congress gave the Fed. First is maintain stable prices in the economy. That is essentially to keep a check on inflation. The second is to support maximum employment in the economy. So if you want to think about the economy as a car, the Fed has its two options of either pushing the gas pedal or pushing the brake. And these are the two things the Fed is going to do. And it's going to do this by putting cash into the economy or pulling cash out of the economy. So what are some of the tools that the Fed uses to speed up the economy or slow down the economy? The first is going to be a reserve requirement that the Fed puts on banks. This is essentially saying to banks, if you're going to be lending out money, you have to keep this amount in reserve. So the higher this reserve requirement goes, the less money banks are going to actually have to lend out to the economy. If they reduce the reserve requirement for banks, then the banks are going to have more money to lend out. This is going to put more money in the economy, stimulate the economy, and reduce interest rates. In 2020, because of COVID, the Federal Reserve reduced their reserve requirement for banks down to 0%. This was an issue with liquidity in the markets. The markets needed cash, so the Federal Reserve said, we're bringing down our reserve requirement to 0%, so you can use that amount that you had in reserve, around 8%, you can go ahead and use that, put it into the economy, and start lending. One of the other big parts of the Fed toolbox is open market operations. So what the Fed can do to put money into the economy is to buy securities from banks. So if the Fed is going to buy securities from a bank, they're going to give that bank cash, and in return, they're going to get a security. That's going to give the bank more cash so that they can lend that money to consumers, to businesses, and stimulate the economy. If they want to reduce the money supply, they're going to purchase from banks securities. So the Fed is going to get securities from the banks and reduce the banks' balance sheets. This is going to increase mortgage interest rates. Another part of this open market operations is what we hear so much about, and that is the Fed funds rate, which is due to be increased again next week by what the consensus is 50 basis points. So the Fed funds rate is the rate at which banks borrow from one another. The banks, as we talked about, have to keep cash. They have to have adequate cash after the end of each business. So let's say Bank A lent out a lot of money and they need some more cash at night. They're going to borrow from another bank, and they're going to borrow at this Fed funds rate. So the Fed is going to set this rate, and the higher they make this Fed funds rate, the more expensive it is for banks to borrow with one another. This is going to increase the amount that savings accounts are paid to consumers. So you're going to get paid more for saving because it's more expensive for banks to borrow money. They're going to borrow the money from you and pay you a little bit. And as you can see in the chart, as of July, this has actually tripled. Since the Fed started hiking their interest rates, savings rates have increased. So what we've also got in this Fed funds rate is the opposite of that. They're going to pay you more for saving. It's going to cost you more to borrow. And it's going to directly correlate to things like credit cards, auto loans, and home equity lines of credit. As the Fed raises their rate, it's going to become more of a higher interest rate on those types of loans from consumers. The current range of the Fed funds rate is 3.75 to 4%. And we say it's a range because the Fed has some tools to keep it in a range, but they're not exactly setting it to a specific exact rate. And one of the ways they do this is what's called the interest rate on reserves, on reserve balances. So the Fed, these banks have the option of keeping their reserves with the Fed or keeping them in their bank. And if they keep them in the Fed is going to pay them interest on this amount of money that they've kept with them. So the Fed adjusts this interest rate so that it becomes more beneficial for banks. If it's a high amount of interest they're receiving, then they're going to keep more money in the Fed. They're going to reduce the amount that they're lending out, keep it in the Fed, and vice versa. So this is kind of the way that the Fed sets their actual funds rate, is by adjusting this interest rate on reserve balances rate. A couple other ways that people have probably heard of that the Fed is going to increase money supply or reduce money supply in the economy. First is quantitative easing, which came along after 2008. After the markets collapsed, we saw a liquidity issue back then. Banks needed money. So what does the Fed do? The Fed is going to go ahead and buy US Treasury bonds and purchase mortgage-backed securities from the banks, giving them cash in return for those bonds and securities. We saw a lot of this going on in the years after the 2008 financial crisis. And this was to prop up the US economy and to make sure mortgage interest rates remain low, to try to stimulate some refinance activity and purchase activity to try to help the housing market. The flip side of that is quantitative tightening. This is when the Fed is going to be selling treasuries and mortgage-backed securities and reducing the amount of cash in the economy. That is not currently going on. We have stopped our phase of quantitative easing, but we're in what's called tapering. So it's the in-between between easing and tightening. And what's going on here is, so the Fed buys a US Treasury. You get a US Treasury bond. You get a yield every 6 months. You get a payment of interest every 6 months on this bond. And then at the end of the term, let's say it's 30 years, that bond matures. So you get what you put into it, the principal balance is paid back to you. And during tapering, instead of taking those bonds that are maturing and the Fed is getting that money, instead of taking that money and reinvesting it, the Fed is not doing that. They are just taking the principal of the matured bonds. So instead of selling, they're just taking and not reinvesting currently. Also, so we've talked about home equities and credit cards and auto loans being directly affected by this Fed funds rate. As you can see in the chart, mortgage-backed securities are a little bit different. Your mortgage rates are going to be based off of this, and this is because mortgages are pulled together and sold as investment securities. So whenever the mortgage-backed securities rates are determined by investors, not necessarily the banks themselves. They're determined by the demand of the mortgage-backed security bonds. And so as you can see, over the last 30 days, since the Fed raised their Fed funds rate 75 basis points in early November, they raised it 3/4 of a point. But since then, mortgage interest rates have dropped 3/4 of a point. So we're at the turning point, and this disconnect kind of happens at the turning points, where you see the Fed increasing, but the market is seeing inflation figures showing that the Fed is doing what they're supposed to be doing to inflation. So the market is taking into account the things like the CPI report, the PPI report, the CPE report, employment figures that we get. Investors are taking all that into account and betting that the Fed has basically done enough and it might be raising rates a little bit too much. So we're expecting rates to continue to drop. And that's where we're seeing this rate drop. And we've also got a PPI, Producer Price Index report, coming out this Friday. And next week we have a Consumer Price Index report coming out before the Fed rate hike. So what we're going to see is, where's inflation now? This is going to adjust mortgage interest rates, and this is going to continue. Hopefully we continue to see low inflation figures. which are going to lead to low mortgage interest rate going into 2023. We're hoping around 5% by the end of the summer. So the Fed's going to be hiking by 50 basis points next week is the consensus, but that doesn't necessarily mean mortgage interest rates are going to increase. Over the next couple of months, it's going to be a little choppy, but we do hope to continue to see the trend that we've seen over the last 30 days. Mortgage interest rates continue to drop, more buyers coming back into the market, and because of that, more housing activity and a little bit of a shift more towards the seller's market in 2023. If anybody has any questions on any of this, please feel free to reach out to me. Follow me on Facebook, YouTube, or Instagram. I hope everybody has a great rest of their day, and we will keep you updated on the reports as they're coming out.